Although European hopes helped propel global equity markets overnight, we did, as we've been saying, see a pullback on Wall Street on the report in the Financial Times. As said, there's a new split emerging in the Eurozone over the terms of Greece's second bailout fund. The report says as many as 7 of the 17 members are now apparently arguing for private creditors to take a bigger haircut. So that's why we saw some slim down gains on Wall Street. Let's bring in Ashraf, Laidi, who is Chief Executive Officer at Intermarket Strategy. Welcome, nice to see you on the set here.
Thanks for having me.
We were talking to one guest this morning who was telling us that the $440 billion was enough as long as it was supported by ECB measures as well on the markets. But you're saying to us this bailout fund is nowhere near sufficient.
Yes, Karen, it was enough. It's less than half a trillion euros. It was enough when it was supposed to address the problems of Ireland, Spain, each of which have a debt of no more than $500 billion. But now the big problem would be Italy, whose debt is around $2 trillion. If you remember in May 2010 when the ECB used to buy bonds against its own wishes, it was buying around 60 billion, 70 billion. Now it's around 157. It's going to have, not only the ECB has to buy a lot more, but it's going to be very instrumental in basically putting money for this EFSF fund. Now let's say it is going to be enough. Let's say they will raise it from 440 to 800 billion or 900. And if the ECB is able to put that money, who is going to basically assist the ECB in putting that money when the bonds that it's holding are going to be hit by what we are thinking is going to be called a default in Greece ahead of the G20? So basically, and you know, you're hearing the word ring fence. The problem is with Italy. They have around 1.8 trillion euros. The EFSF is 440 billion. So you need to at least double that amount. But even if you do, how sustainable is this fund is going to be? And the fund is a form of a bond. It's basically going to be issuing money to tackle a problem. What's going to happen to the rating of this EFSF? Or that is later going to be called the ESM. So I'm not even worried about whether they're going to vote to apply it. I assume that all they're going to vote and they're going to say, fine, let's do the ESM. I'm thinking about after that.
You highlight significant issues there, but doesn't this come down to whether you think Italy is going to default or not? Because if it's not going to default, then the fund is sufficient.
Yes, it is true, but the way we have learned in this thing is really the contagion, is the impact of contagion. So they don't even have to default, even if they bring Greece to a civilized default. It's the way the LIBOR goes up in the US dollar. It's the way the sentiment goes down in the euro. And that's why we have been speaking now for the last month and saying that we are expecting to see the euro below 130 or 129 before the end of the year and towards 118 in the middle of next quarter.
Ashraf, it's Bernie up here in Hong Kong. You'll forgive us, but this is getting more and more confusing as the days go by. What are we talking about here? Are we talking about a European version of TARP? Is that in essence what it is? I mean, you know, it's been years since TARP. Certainly we can come up with a better beast than that, right?
Not yet. This is because TARP would be basically taking basically stakes in banks, in European banks. We're not even talking about that. All of this little speech that I gave you guys here is really on the sovereign level. Okay, it's to basically stabilize the issues, is to weigh on the yields on the sovereign section. But I do agree with you that eventually there has to be some sort of a TARP, which is basically going in and taking a part of these banks. The problem right now still remains on the sovereign level, and that's what the EFSF is about.
Isn't the market having a difficult time with managing expectations here, which is really important, because they need to realise that if policymakers underwhelm, if there's a lack of consensus, if they don't manage to leverage the bailout fund, then euro could take an absolute pummeling. Is it beyond the realm of possibility it can drop below 130 against the dollar?
No, it's not. No. I mean, it's you know, I don't even need to use the argument of the EFSF or really the ESM. Guys, if you look at a monthly chart of the euro dollar, and you start from 2006. That upcycle that we had since 2006 was as a result of the Federal Reserve no longer raising rates and the ECB raising rates. So from 2006, 2008, so the euro went up. And then we had the deleveraging in 2008, and the money went back into the dollar. Anything, there is a way from the US dollar into the dollar, into the yen, and it came down. Then in 2009, the Federal Reserve came out with QE1, injecting liquidity, increasing the supply of US dollars, value of the dollar goes down. That ended in basically basically end of 2009, early 2010. No wonder why the dollar stopped falling and the euro continued to fall. Also, the euro had its own reason, which is a sovereign debt. But then here's the thing. The QE2 in the US ended in June 2011. Look at a chart in the euro. The euro peaked at around May to June 2011. Now what do we need for the euro to go up? We need a very aggressive easing by the Fed. Operation Twist is not. You are selling money because you're selling bonds here and you're buying bonds. There is no expansion of the balance sheet. It's not enough to bring down the euro, to bring down the dollar, to push up the euro. And that's what's happening. So this is another way to simplify where the euro is going to go. And that's why it is definitely, I mean, we could see it's very highly expected. We are going to see 1.29. A month ago we said by year end. It looks like we're going to be in 1 month. And then we're going to see 1.18.
That's well off that 1.6 peak that we saw back in 2008 that you've been mentioning. We're going to come back and speak a lot more with Ashraf Laidi from Intermarket Strategy in just a bit. Questions or comments? Squawk at cnbcasia.com. We'll be right back.
Our guest this half hour, Ashraf Laidi, is Chief Executive Officer at Intermarket Strategy around the table, the SGX with Karen and Shri, is very, very pessimistic on the fortunes in the euro, predicting 129 versus the greenback by, say, next month or November, and then basically one way down to 118 in Q1 of 2012. You 150% sure about that, Ashraf? There's nothing that could change your mind?
No. But, you know, the last time we were so sure that some things were going to happen as far as the euro, it would happen earlier than we thought. When people go on TV and they say, we think it's going to happen by the end of the year, you know, this is a way to play it safe. But there's many things, you know, off the air, we were talking about the EFSF and talking about the sovereign stuff. But there is something else, which is the ECB rate cut. Okay, so Karen was saying to me that maybe Jean-Claude Trichet is going to try to save face and he's not going to be able to take out that rate hike that he did. Fine, let him go, let the successor come in and he will do the rate cut. We are talking about expanding EFSF. We're talking about the ECB, May 2010, when it said, no, we're not going to buy any bonds. Then they said, okay, we're going to buy 50 billion. Now they had 150 billion. There has been examples of the ECB doing things against its own wishes. And the rate cut, it's the last of its problems.
You know, this urge to cut and, you know, this concept of coordinated monetary easing is creating a complete conundrum for a lot of the Asia-Pacific central banks. I mean, you've seen what the bank, just to use one example, you've seen what the Koreans have had to deal with. Where is this going to end up, you know, as far as the Pacific Rim? All in tears?
No, not all in tears. It's a question of, look, you know, you look at the emerging market currencies, the Singapore dollar, the Korean, and all of this. Yes, we know they go up when things are fine and when risk appetite is fine, and they go down when there's an unwinding of these trades and so on. A lot of it, Bernie, it depends on what happened to China. Is it going to slow down? Is it going to have a soft landing like the Boeing that you saw on TV? Or is it going to be a hard landing? Or is it really going to be a big contraction? If it's going to be just a soft landing, we're going to start thinking about, yes, Asia will slow down, but which of the Asian nations is going to rebound faster? In the currency world, is it going to be the Scandinavian currencies, or is it going to be the Southeast Asian? This is going to be the big question if we're going to have a big rebound. Is it called being very, very, very pessimist, thinking the euro is going to go to 130? Not at all. Some people are saying 118, 116, but it is basically unwinding and undoing some things that were done, which is the rate hike.
We'll call it the Dreamliner landing, just to keep it consistent today with that landing we saw in Tokyo. You know, when we've been talking about emerging market currencies and some of the risk currencies, markets have been very rattled by a change in perception about interest rates here, whether we might see a halt in policy or a cut in policy on some of these very strong economies, and that's been very nerve-wracking for the yield chasers. When it comes to Europe, and if we see a rate cut in Europe, how big a ruction is that going to cause? Because not a lot of investors have been chasing yield in Europe.
It's going to empower the dollar trade. It's going to empower, the dollar. The dollar had been hurt because of the divergence in the interest rate the situation. You've had the Fed jumping into QE2 while guys were still raising rates. The process of removing that, it's like in July 2008 when basically the ECB later on said we're going to have to cut rates many months later. There was an unwinding process, and that will be very, very much into the dollar and the yen, which we should not forget. The yen is going to go up also further.
Ashraf, we're going to make regular bookings with you October, November, and Q1 to do some checkup calls. Appreciate your time today. You stay well, okay? Have a great...
let's bring in Ashraf Laidi, Chief Executive Officer at Intermarket Strategy. He's here as our guest host. We've got some of your emails for you. What's your outlook for the Swiss franc? Will it continue to weaken against the US dollar if the euro dollar goes lower?
Will the Swiss franc continue to weaken against the US dollar? Yes, we do think that even if the 1.2 peg in the euro Swiss is going to hold, it's a question against the euro. But I think that the resulting rebound in the US dollar due to rising LIBOR for the US dollar is going to also take the Swiss under its wing. So the dollar would rise against the Swiss franc. The only currency that the dollar is not expected to really appreciate against, or actually is expected to weaken, is the Japanese yen. It's very interesting. A lot of people are talking on TV here, and they always refer to dollar strength, dollar strength. The yen continues to outperform the US dollar. An alternative to selling euro dollar, sterling dollar, Aussie dollar is still Aussie yen. Yes, they intervened, but they will not intervene again. They may try to do it solo, but they know that it would work for probably 5 hours or 4 hours. Well,
the S&B spooked investors by intervening. So what if the euro goes down to your forecast around that 118 level? What happens to the Swissy then?
We think then there would be a big challenge. Well, it depends how it happens. Does it happen because of something that is Eurocentric, because of a default in basically Greece, or because there is a breakdown in the talks regarding the EFSF? If it's Eurocentric, there's going to be a very big challenge to hold that 1.2 level. And I think the Swiss National Bank is going to have to intervene. We don't tell our clients to even play with the Euro Swiss. We don't want to go and stand against the freight rate. But definitely it would be under threat, that 1.2 level. And that's why they said, that's why the S&B said that we might even try to push it towards 1.25.
Ashraf, Sven Helge Nielsen, Norway, asks a really good question. The PIGS countries have a lot of gold. Why don't they just sell it? That's to help pay down their debt. That's
what the Slovenians told the Italians, enough of this, and why don't you sell gold? When the Germans were trying to meet the Maastricht Treaty in 1996, basically the German government was trying to think of selling gold to try to bring more money into, and the Bundesbank said don't do it. We think that the Eurozone do not think that there is still a big enough problem to sell their bread and butter, their gold reserves yet. And if they do, we may see a big decline in gold, and it may actually hurt, guess what? The holdings of the central banks of basically around the world. Why would they want to do that? Do you think the central banks, when they get together in their monthly meetings or in their meetings, you think they're going to allow them to sell the gold?
It's another type of contagion.
Thanks to you, we're going to lose all the book value that we have on gold. So there's a lot of these basically solutions, do something, sell your Greek real estate, raise your Greek taxes, sell your Italian gold. But I think selling gold is less realistic than telling the Greeks to sell some of their...
You've got to be careful of the ripple effects. Also, you have a treat for us. One of your key ideas in your letter to clients is about the 1-month volatility for euro-dollar. Why is this relevant?
We look at the 1-month volatility of the euro-dollar. It's something that we tell the clients to look at, and we use it as a leading signal. It is the equivalent of the VIX. It's like the VIX for the euro. Okay?
So what's the signal telling you now?
The signal is basically telling us that if you look at this chart, it's around 18, and we think that it's going to push higher. It is 18. It is the same level at which the 1-month VIX or the volatility peaked in May 2010 when the euro bottomed, and in March 2009 when the euro also reached a bottom. We are at that same level right now. If you look at the 1-month V chart for the euro, it is at a triple top, but we think the technicals of this 1-month volatility is expected to break above 18 and go towards the 20s, which would be in line with what we said earlier,
negative
further declines in the euro.
Thank you so much for sticking around with us to speak to some of our viewers on their emails and also to chat to us about some of your client ideas. Much appreciated.
Thank you.
Ashraf Laidi from Intermarket Strategy up next.